this is Dean Cheeseman from Mattioli Woods. I'm back at T. Rowe Price's London offices and have the opportunity again to have another conversation with Ritu Vohora from Global Capital Markets at T. Rowe Price. We're going to pick up the conversation. Last time we spoke in November, just after the US election. We're picking up now for a date stamp in order. There's so many moving parts here. I think it's important that we just make it clear. So we're beginning of July. And I'd just like to start, just sort of reflect on the markets year to date since we spoke last. And I'm just going to give the context of that last time we spoke about inflation, that last sticky bit of inflation, trying to get to where the central banks were hoping for their long-term targets, the unknowns around geopolitics, and then reasons at that point to be upbeat, the US exceptionalism. So 6-7 months on, how does that play out?
Firstly, thanks for having me again, Dean. It's great to see you again. And what a 6 months it's been. I'd say it's been a constantly changing market narrative since we last spoke. And I think how I'm thinking about it is a global recalibration. You know, we're seeing seismic shifts from a technological standpoint, economically, geopolitically, but also from market leadership. And of course, since we spoke, Trump policy's now gone from just being pledges to actually being implemented. So we've had a lot of executive orders around immigration and of course tariffs. Now, tariffs has been the key narrative for markets so far this year. We had the big shock back in April. If we remember, that was incredibly painful. We had a lot of fear in the market. And I think for investors at that time, it was kind of pricing in a very wide range of scenarios. And I think since then we've had a de-escalation. So that probably most negative scenario is off the table. But as we know, the narrative keeps changing. There's still a lot of uncertainty. And that's had a huge impact not only on confidence, but also activity, because companies just don't know how to invest when they don't know what the lay of the land is going to look like. So what's interesting, though, is I think equity markets have just continued to climb that wall of worry, and they've been incredibly resilient given this uncertainty. And particularly when we think about outside of the US, we've seen a leadership from emerging markets like LATAM, but also Europe. And I think, you know, your point around US exceptionalism is a question that I've been getting pretty much the most this year. And I think rightly so. I think we are starting to see cracks in some of those pillars of exceptionalism. So if you think about AI, you know, the US is dominated in that area, but we had news of DeepSeek from China. That's brought into question around genuine competition to the US and whether they can continue to have that monopoly. You've also had exceptional growth in the US for the last couple of years, and that's been very much driven by fiscal policy. But now we had an announcement since we last spoke from Europe with their big fiscal package, but also China. So that gap is going to start to narrow. So that US exceptionalism on growth maybe a bit less than it has been historically. But also with Trump's policies, they're so erratic that it's made investors question their trust in US institutions. And I think one of the most interesting things we've seen over the last 6 months is how we've seen kind of those safe US assets just behaving badly. You know, the dollar has underperformed in a period of high risk aversion, which tends to never happen. You've had US Treasury markets have been incredibly volatile. So it's been an interesting year. I think there's been a lot of uncertainty and volatility. But I think as we sit here today, we're a bit more constructive. We've just had the one big beautiful bill, which is Trump's fiscal policy, been signed off. And I think that's given a bit more confidence to markets that maybe the growth outlook is maybe better than the recession when we probably spoke at the back end of last year.
It's amazing, isn't it, that we find that politics is central to the macro environment and the backdrop. And ordinarily, politics shouldn't feature front and centre. It's a driving force behind, but it's market fundamentals. So, again, thank you for that back sort of review where we've come from since we spoke last. Looking forward, what's the outlook then for the remainder of 2025?
Well, no crystal ball, but I think you absolutely point out right. I think, you know, macro has driven market sentiment, but given the resilience we've seen in equity markets, I think gives us some comfort that ultimately fundamentals do matter. And I think we can probably look at a bit more of a half more full than empty where we sit today, particularly from a growth perspective. So, you know, when we heard first about tariffs, I think the view was that growth would slow meaningfully, particularly in the US and probably here in Europe. But now that we've had this new fiscal announcement with the one beautiful bill, I think that means we could see at least growth in the US on a 6-month horizon, get a bit better. So I think global growth will expand, but it'll be quite sluggish. And I think what's interesting when we look at Europe is, we've seen a lot of front loading ahead of tariffs. So actually the data in Europe's been pretty good when you look at manufacturing PMIs. But again, I think we're borrowing from the future. So at some point, I think in Europe, we could see growth slowing over the next 6 months. But once you get the fiscal spending again on defense and infrastructure, then growth should reaccelerate in 2026. So I think we're a bit more constructive on growth than maybe we were just a couple of months ago, particularly in the US. Now, of course, tariffs haven't gone away. We're now in July. This is when the reciprocal tariffs, the pause was going to end. And Trump's been sending a load of letters recently. But again, he's pushed that deadline to the 1st of August. And the acronym is TACO. Have you heard of TACO?
TACO, it's causing a few smiles.
Yeah, so Trump always chickens out, right? I mean, I think it was coined by the FT. And I think, the view is tariffs are very serious in terms of their market implication, but maybe we shouldn't take them literally because he does love to negotiate. And I think over the next couple of weeks and months, even as we approach that August 1st deadline, we will see some negative surprises. We saw that recently with South Korea and Japan and Vietnam. But again, I think that's again a prompt for negotiation. So I think the good news is maybe tariffs aren't as ugly as they were back in April, but we're still going from 2.5% at the beginning of the year to maybe 10, 15%, right? So it's still going to impact corporates, it's going to impact inflation. So I think, your point on inflation when we last sat down was it was quite sticky. I think we've seen a progress in inflation coming down, but particularly in the US, I think there's an upside risk here, particularly on the back of tariffs. You've got a weaker dollar and you've got this fiscal package. So I think we see inflation possibly reaccelerating in the US, but we could see disinflation for the rest of the world, particularly if a lot of those cheap goods get dumped here in the UK and Europe. And so that has implications, of course, for the Fed, and they will be balancing between the outlook on inflation, but also a marginally improving growth outlook. And particularly when we look at the labour market, and we had labour market data last week, the economy is still doing okay. Labour markets are pretty solid. They're not as tight as they were back during COVID. They are starting to loosen a little bit, but we're not seeing mass layoffs. Unemployment rates are still quite low. So the economy is still in a fundamentally good place. And I think for the Fed, it's good news that we are sort of winning on inflation. Tariffs aren't as ugly, but I think they will proceed cautiously. So we do expect them to cut maybe 2 times later this year. I think for Europe, we've had more progress on inflation. Growth is a bit weaker. So they'll probably cut maybe 2 or 3 times this year, but we think they will then hike in 2026, particularly as growth starts to reaccelerate. And the same with the UK, we've seen progress on inflation, so we do expect maybe another 2 or 3 cuts over the next 12 months. So lots to think about there. And finally, I'd say on the fiscal side, I think, particularly the bond market, they've forgotten about tariffs and they're focusing on fiscal. And this has huge implications, not only because of this one big, beautiful bill in the US, which on the plus side will be good for growth. Corporates will start spending, but they are going to add $2 trillion to the deficit, which is already around 6 to 7% of GDP. And it's not just the US, right? Germany's going to be spending, China's going to be spending. And all this means is governments need to issue a ton of bonds. What does that mean? It means long-term bond yields have to go up. That means we should expect more volatility in sovereigns, but also steeper curves. And that has huge implications for asset prices more broadly.
So I think that acts as a really interesting conduit as we move from the macro into the markets. The steepening bond yield curve, the knock-on implications that has as we move up the risk spectrum, investment grade credit into high yield, and then into equities. Where do you see the investment opportunities as we look forward now?
Yeah, so from our asset allocation committee, starting at the beginning of the year, we started de-risking a little bit, very cognizant of some of the uncertainty we were going to see through 2025. So we reduced some of our equity position. We were marginally underweight, but I'd say broadly we're now neutral on stocks versus bond. You know, this is not a time to be a hero. There's still a lot of uncertainty, but I think where we still see value is in value. Excuse the pun there, but you know, I think value still looks really interesting from a valuation standpoint, but also this year it's acted pretty defensively, and it's been absolutely the right call, particularly as we've seen sort of that rotation out of US growth and tech into other areas, not only by sector, but across regions. So I think value still looks really interesting for a number of reasons. You know, we talked about inflation is probably going to be stickier, rates probably stay higher for longer, but also we're now seeing through trades and tariffs, we could see a lot of reshoring. That means, you know, building domestic manufacturing, but also AI is still going to be very energy intensive. It's going to need to build that infrastructure. Possibly we get deregulation coming in the US, which would be good for financials and banks. So all of this, I think, bodes very well for value sectors. So here I'm talking about things like financials, materials, energy, infrastructure and real estate. So I think that's still an opportunity. And when I look across our portfolios, I think financials is an interesting area because number one, we're now seeing an environment where maybe, particularly in the US, we get deregulation. You've got higher rates, that's good for interest margins, loan growth, and a lot of US banks have just passed their stress tests, right? So they're in a good position. And I'd say more broadly, you know, looking outside of the US, so we're positioned looking internationally. So when we think about some of the opportunities today, whether it's in European defense or Japan, there's some interesting opportunities outside of the US today where valuation's a lot more attractive as well. And finally, when you're thinking about inflation, you know, I think again, inflation's not going away anytime soon, particularly given tariffs. So having some inflation protection, so again, really leaning into things like real assets and commodities, but also inflation protected bonds. And to your point on fixed income, I think, you know, we are in a world where the long end of yields is going to go higher. We should prepare for steeper curves. So managing duration is incredibly important. But I'd also say there's opportunity going global. We're now seeing a divergence in policy from developed market sovereigns versus EM. So you're getting some great opportunities outside the US, and particularly in areas like emerging markets today.
And that opportunity is what really excites us as we look forward, and the opportunity. And if I bring it now to the client portfolios and specifically to the diversified income portfolio, which T. Rowe Price kindly guide us on, the investment opportunities specific to that mandate across that opportunity set as you've just set out. How do you see that?
Yeah, well, first I'd say on positioning, I think, you know, as we've talked about, there's still a lot of uncertainty, right? So I think we need to prepare for a wide range of outcomes. And that's where having a robust framework really matters, right? We need to not focus on short-term noise. We need to have a very consistent approach to prepare our portfolios for the long term. So thinking about creating portfolio resilience, capital preservation by having that quality within portfolios, but also diversification that we've talked about. I think that is incredibly important for two reasons. One, to manage risk. It's a great way to manage all the different sort of levers in the market today, but also it provides different opportunities for alpha generation, whether it's, as we've talked about, in value sectors or outside of the US. So I think that's incredibly important. And so again, when you bring that to where we're seeing it in terms of income opportunities, I think there's three areas we see most compelling areas is bonds, particularly in credit. So high yield is a sector where you're still getting around 7-8% yields. It's a great time to lock in that income. I know spreads are quite tight, but when you look at that all-in yield, it's very attractive today. But also when you think about emerging market debt that I've talked about, it provides some diversification. And again, you're getting around 6-7% yields there. And we supplement that with the equity side, so looking at dividend-paying stocks. You know, these are genuinely good quality companies. They have strong balance sheets, good cash flow, you know, good quality businesses that can not only have stable dividends, but grow them over time. And that's incredibly powerful, that compounding effect over time to help with that income generation. And then finally, real estate. I think real estate is an area, particularly when you think about, you know, REITs, is an area where you get not only a stable income, but if you think about a world where inflation is higher, a lot of the rents are tied with inflation. So if you've got a longer term horizon, I think that's another way to provide some inflation protection, but also have that income generation. So bringing all together, I think there's still lots of uncertainty, but having that diversity in terms of geography and asset class, having that capital preservation, but really focusing on those income areas puts the portfolios in a great place despite all the uncertainty in the markets.
As always, diversification is absolutely key. Ritu, really appreciate your time today. Thank you so much for your insights.
Thanks so much for having me. It's been great. Thank you.